Welcome to The Deep Dive, the show where we take complex info and really distill it down into the insights you need. Today we're doing a deep dive into Surgery Partners, Inc., ticker SGRY. They're right at the center of this huge shift in healthcare, moving complex surgeries out of hospitals and into these outpatient centers. We're going to break down their Q2 2025 earnings call, see how they're handling this big market opportunity.
Yeah, this is a really interesting one. SGRY is a key player in the ASC space that's ambulatory surgical centers. We'll look at their numbers, their strategy, and importantly, how they fit into these big industry changes, especially some potentially game-changing regulations coming down the pike.
Okay, so let's jump right in. The headline numbers for Q2. What did Surgery Partners actually deliver? What's the first thing that jumps out?
Well, they put up a pretty solid quarter, consistent execution, really. Financially, GAAP EPS was minus 2 cents. Now, still negative, yeah, but way better than the minus 12 cents last year, so definite improvement.
Okay, improvement on GAAP.
Yeah.
What about the adjusted number? That's often what the market looks at more closely, right?
Exactly. And their non-GAAP, or adjusted EPS, came in at $0.17. That actually beat the consensus by a penny. It might seem small, just a penny, but combined with that GAAP improvement, it really signals some strong operational momentum, shows they're moving towards profitability fast.
Right, that operational strength. Did that show up on the top line too, revenue and profitability?
Absolutely. Revenue hit $826.2 million, also beat estimates. That's up 8.4% year over year. Pretty healthy growth. And their adjusted EBITDA, that's earnings before interest, taxes, depreciation, amortization, was $129 million.
Okay, $129 million. How's that compare?
That's up 9% from last year, and the margin was 15.6%. Just a slight improvement, like 10 basis points, but still, it's expansion. Shows they're not just growing revenue, they're managing costs too.
Okay, so growing revenue, improving margins slightly. How much of that growth is coming from their, existing centers versus new ones?
Good question. Their existing shops, same facility revenue, grew 5.1%. That came from more cases, about 3.4% more, and a bit more revenue per case, up 1.6%. So a mix of both volume and pricing power, essentially.
And the balance sheet. Cash, debt, how healthy are they looking? Especially for a company that's growing.
Pretty healthy, actually. Generated good operating cash flow, $81.3 million. They ended the quarter with about $250 million in cash, plus nearly $400 million available on their revolver. So decent liquidity. Leverage, though, that's something to watch.
It was around 4.1 times based on their credit agreement calculation.
4.1 times. Okay, so solid results. Seem like investors would be reasonably happy. But let's get underneath those numbers. Management talked about 3 core growth pillars. What are they, and how are they actually driving this performance?
Right. Their whole strategy boils down to 3 things: organic growth, improving margins, and using capital smartly for M&A. So first, organic growth. They did almost 173,000 surgeries in Q2 in their main facilities. That's up 3.8% from last year, just steady demand. 173,000 cases. That's a lot. Which areas are growing fastest? Does it fit with what we're seeing elsewhere in outpatient?
Yeah, they saw really strong growth in GI, gastrointestinal, and MSK, musculoskeletal. And here's a big one, total joints, like knees and hips, up 26% compared to last year.
Wow, 26%. That's huge.
It really is. And it totally lines up with that big trend of moving complex stuff outpatient. Get this. 80% of their centers can do these higher-level orthopedic procedures, and almost half are already doing total joints. So they're really positioned to grab that demand as it shifts.
Okay, but doing more complex cases like total joints usually needs investment, right? Better tech, the right doctors. How are they managing that?
Exactly. They're investing. They've put 69 surgical robots into their centers. That helps enable these tougher cases. And that tech is also a big draw for doctors. They recruited almost 300 new physicians in the first half of the year, a lot of them in orthopedics.
But are these new doctors actually bringing in business?
Seems like it. They said their 2024 recruits brought in 68% more cases and 121% more revenue in the first half of this year compared to how previous groups started out. So that strategy is definitely paying off.
Okay, so that's building from within. What about brand new centers, their de novo strategy? How's that playing out?
Yeah, the de novos, that's building from scratch instead of buying. It's a key part of their long game. Since 2022, they've opened 20 of these. 12 are already profitable. They've got 10 more being built right now and a pipeline beyond that. And crucially, these new ones are heavily focused on ortho and those higher value procedures.
How long does it take for these new places to, pay for themselves?
Yeah.
And is it actually cheaper than buying existing centers?
They take time, yeah. Usually 6 to 12 months just to break even. Then maybe another year to get to full speed. It's an investment. But the payoff is that the cost, the effective multiple they pay is way lower than buying an established center, much more capital efficient long term. Plus, a lot are unconsolidated, so the money comes in as management fees and equity earnings. Steady income. And a big advantage. With a new center, they can often negotiate better initial rates with insurers because they're shifting care from more expensive hospitals.
Ah, that makes sense. Leverage that cost saving. Okay, pillar 2, margin improvement. Are they actually delivering there beyond that slight bump we saw?
Yeah, they are showing discipline. It was modest expansion this quarter, but consistent. If you look closer, costs like salaries, supplies, even G&A, they all improved as a percentage of revenue compared to last year. Little efficiencies adding up, and management sounded pretty confident they can keep expanding margins. It's baked into their guidance for the year. Seems like an ongoing focus.
Okay, makes sense. And the third pillar, M&A, mergers and acquisitions. What's the target and how are they doing on that front?
They're aiming for about $200 million in deals for 2025. So far, they've spent $66 million, added 8 surgical facilities. They said they got them at good prices, attractive multiples.
Only $66 million out of $200 million target, though. Seems a bit slow.
It is slower than they initially planned, yeah. And they acknowledge that might mean their full-year adjusted EBITDA ends up at the lower end of their guidance range, but they stress they're being disciplined, focusing on the right assets, not just hitting a spending target, which, investors usually appreciate. On the plus side, the costs for doing deals and integrating them actually went down quite a bit, 27% from Q1, should drop more. So they're getting better at the process.
Okay, disciplined approach, getting more efficient. So they've got this growth plan, but what about funding it? Especially the debt. You mentioned that 4.1x leverage and interest costs.
Right, that's key. Interest payments did go up about $23 million more than last year's Q2. That was mainly because some interest rate swaps they had expired. They replaced them with caps, which limit the variable rate to 5%. Protects them somewhat, but yeah, costs went up initially.
So with costs up and ongoing investment, what's the plan for that 4.1 leverage number?
They have a very clear target. Get it down to the upper 3x range by the end of this year, and keep bringing it down after that. Deleveraging is definitely a priority. Partly through earnings growth, but also they're looking at, quote, asset portfolio optimization.
Optimization sounds like maybe selling some things. Or new partnerships.
Could be, yeah. Selective asset sales, maybe expanding partnerships. The goal is to speed up paying down debt, boost cash flow, and give them more flexibility to fund growth internally, less reliance on outside money.
And do they have enough money for all this? M&A, building new centers?
They think so. They project they have enough liquidity, cash, revolver, operating cash flow to cover M&A and growth for the next 5 years. And importantly, they think they can do it without needing to raise more debt or sell more stock. Plus, no major debt due until 2030. That gives them a lot of breathing room.
Okay, that financial flexibility is huge. Now, let's shift gears. This is where I think it gets really interesting. Regulation. What's happening there that could seriously impact SGRY and this whole outpatient world?
Oh, this is potentially massive. The regulatory scene is looking like a major tailwind for them right now. CMS, that's Medicare and Medicaid Services, they put out a proposed rule for 2026, part of their payment system updates for outpatient and ASCs, and it's very supportive. Get this. They're proposing to phase out the inpatient-only list over 3 years.
Whoa, the inpatient-only list. Gone. What does that mean practically?
It means procedures that had to be done in a hospital by rule could now potentially move to an ASC like Surgery Partners operates. And on top of that, they're proposing adding around 271 new procedures to the list of things Medicare will cover in an ASC setting starting in 2026. This isn't just tweaking things, it's like unlocking a door to a much bigger market.
Okay, that sounds game-changing. How does management see this impacting their actual business? Is it just more Medicare patients or is there more to it?
Management sees it as empowering doctors, basically, letting them choose the best, often most cost-effective place for surgery. Removes hurdles. Now, the extra volume just from these newly approved Medicare procedures might be modest at first, but the real impact is enabling more complex cases overall. It makes it easier for surgeons to do their whole range of procedures in the ASC. That simplification could pull in a lot more commercial cases too, not just Medicare. It massively expands their potential market.
Which is already pretty big, right?
Oh yeah, currently estimated over $40 billion. But projections see it going past $150 billion, especially in ortho, MSK, GI. This CMS rule could accelerate that dramatically. It just fits perfectly with the whole system pushing for lower costs and efficiency by moving care outpatient.
Are there any regulatory clouds on the horizon? Or is it mostly clear skies?
Mostly clear, it seems. They have very little exposure to tariffs, minimal exposure, less than 5% of revenue to Medicaid and the health exchanges, so less risk there. Things like site neutrality, price transparency, they expect those to be neutral to maybe slightly positive for them. Final rule is due in November on those. So yeah, overall, a very favorable regulatory picture.
That regulatory clarity is definitely a big deal. What about internally? They finished that strategic review, right? Rejected the take-private offer from Bain Capital. What signal does that send?
Yeah, that decision back in June to stay public, despite the Bain offer, really underscores management's confidence. They clearly believe there's a lot more value to create as a standalone company. And it's worth mentioning Bain is still invested and supportive. Wasn't like a hostile thing. The whole review process just sort of reconfirmed their strategy and position as a leading independent ASC player. They're actually planning an investor day later this year to lay out that long-term vision in more detail. That'll be one to watch.
Right, the investor day. And there was also a leadership change announced. Executive chairman leaving.
Yes, Wayne Dupree, the executive chairman, is leaving to become CFO at United Health Group. That's effective September 2nd. They said a transition plan for the chairman role will be announced soon. Leadership changes always bring a little uncertainty, but this feels more like a big opportunity for him personally, not necessarily a problem at SGRY. Investors will want to see that transition plan, though.
Okay, so wrapping this all together, Q2 results were solid, strategy seems sound, regulation looks like a huge positive. What's the bottom line for someone watching SGRY and this sector? What are the key things to keep an eye on?
Yeah, the overall vibe from the call was, I'd say, constructively bullish, pretty positive. Key things to watch, definitely that investor day for the long-term plan, the final CMS rule later this year, seeing if those proposed changes stick, continued execution, hitting those de novo opening targets, picking up the M&A pace maybe, and, of course, tracking that leverage number quarter by quarter, seeing if they hit that upper 3x target, and watching for continued margin improvement. The stock itself, it's lagged the market in the healthcare sector overall for the past year, but it has picked up a bit lately. Maybe the market is starting to price in some of these positive developments.
Okay. Now, before we get to a trade idea, the usual very important reminder, this is purely for informational purposes. It is absolutely not financial advice. Any ideas we discuss are just for intellectual exploration. Don't act on them without doing your own deep research and talking to a qualified financial professional. Seriously.
Couldn't agree more. Very important disclaimer. But with that firmly in mind, if you want to think about an interesting, maybe slightly edgy but plausible trade idea based on all this, one thesis kind of jumps out. Given how clearly SGRY is set up to benefit from this shift to ASCs, especially with that CMS rule boost, going long SGRY seems like a strong possibility.
Okay, long SGRY makes sense based on everything we've discussed. What's the other side of the trade?
To potentially amplify that bet on the ASC model and the regulatory tailwind, you could think about pairing that long SGRY position with a short position in the broad healthcare select sector SPDR fund, ticker XLV.
Shorting the whole healthcare sector fund. Why XLV specifically?
Well, the logic is this. XLV gives you broad healthcare exposure, sure, but it also includes a lot of traditional hospital systems. And those hospital systems could actually face pressure as these higher value surgeries move away from their inpatient settings and into lower cost ASCs like SGRYs. SGRY has underperformed XLV over the last year. This trades bets that gap could close, maybe even reverse, as the market fully digests these policy changes and SGRY's own efforts to deleverage and boost cash flow. If SGRY hits that leverage target faster than expected, that could be a big catalyst for its multiple to expand relative to the broader sector. So it's a bet on SGRY specifically and on this fundamental shift in how healthcare is delivered.
Interesting. Playing the specific winner and the broader shift simultaneously. Okay, what a deep dive. We've broken down a strong Q2 for Surgery Partners, their pretty clear three-pillar strategy, and these potentially huge regulatory tailwinds.
Yeah, their focus seems laser sharp. Organic growth, smart M&A, building those new de novo centers, and really tackling that leverage. And all of it is happening against this backdrop of favorable regulation. It paints a pretty clear picture of how they plan to create value long term.
So for you listening, the question maybe becomes, as healthcare keeps moving towards these more efficient, high-quality outpatient settings, what other ripples does this cause? What other companies benefit or get disrupted? How does this reshape the whole industry down the road? What part of this big shift grabs your attention the most?
Yeah, think about what really stood out to you here. How might these trends impact healthcare beyond just SGRY's stock price?
You've been listening to The Deep Dive. Remember all those disclaimers we mentioned? We hope this helps you feel more informed and ready for whatever comes next.